Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 16th of February 2015. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. If you are watching this video anywhere other than on our Hurst Trading Room podcast channel on either YouTube or iTunes, then please make sure that you subscribe to those channels because you will be notified of new videos. Thank you very much for all your feedback. I have been incorporating your ideas, and in fact today's video I am going to make brief if I possibly can. I'm going to try not to speak too much about all of this and issue more frequent but briefer updates every week if possible, with a slightly longer update every few months once the markets have shown themselves to have turned following a major trough or something like that. So let's take a look at the markets, and first of all let's start with the stock markets. Here is the S&P 500. Now this is the analysis that I have been looking at and speaking about in these videos ever since October last year. As you can see, the salient features are here a trough of 40-week magnitude. Now you will know that I started thinking of that as a trough of 18-month magnitude because we were expecting an 18-month cycle trough. Then for various reasons I decided that was probably only a 40-week cycle trough. I won't go into those details again. You can watch previous Hurst Trading Room podcasts and you can see the whole discussion there. Some people get very worried about the fact that I quite comfortably adjust the magnitude of a trough from 40 weeks to 18 months and then back again. The reason for that is because Hurst cycles are very robust, and when you are trading on the basis of price interacting with the 20-day FLD, which is of course what I do using the FLD trading strategy, is what our Hurst signal system is based upon, then whether a particular trough is of 40-week magnitude or 18-month magnitude doesn't make a huge amount of difference. The important thing is that it is a trough of at least 80-day magnitude, because of course we trade a sequence of interactions between price and the FLD between each and every 80-day cycle trough. So as long as the cycle trough is of 80-day magnitude or longer, it doesn't make a huge amount of difference. So that's why I don't worry too much about changing the magnitude of that trough. The analysis I've been looking at recently considers that trough in the middle of October 2014 to be a trough of 40-week magnitude. And following that, of course, was a very clear, very beautiful up and down move for an 80-day cycle. So the next 80-day cycle trough was in the middle of December 2014. Then things started getting a little bit less clear, a little more muddy, if you like. And when I last recorded the Hurst Trading Room podcast video, I mentioned that I expected price to come down, drop below the 20-day FLD, which of course it did over here in the last week of January, and I expected it to come down into a 20-week cycle trough. Now there you can see that nest of lows is still there. Now the nest of lows is of course when the trough of a particular cycle is expected. It looks like an inverted triangle at the foot of the chart, as you can see. And now that 20-week nest of lows is still there, and you can see that the 20-week cycle trough is expected in terms of using recent average wavelengths of the cycle. That 20-week cycle trough is expected around about now, in fact in the middle of February. You can see that of course the range of time extends a little bit back into the past, and it extends a little bit back into a little bit forward into the future, but generally that 20-week cycle trough is expected round about now. Now as you approach any cycle trough, you have to consider the fact that it might occur early because of the principle of variation. That tells us that cycles have varying wavelength, and therefore a cycle trough might very well occur early or it might occur late. we have means of determining whether we expect it to occur early or expect it to occur late. And a basic rule of thumb is that if the underlying trend, in other words, the pressure of the longer cycles, is bullish, pushing up, then we expect a trough to occur early. Now, of course, this has been a very bullish market. Stock markets have been very bullish for several years. And that bullishness takes some time to fade away. I have been pointing out bearish signs that have started appearing recently, but the fact is the underlying trend is probably still fairly bullish. It is bullish until it demonstrates that it has clearly turned and has become bearish, and it hasn't done that. There have been signs that I've spoken about in previous videos that the bull is waning, or signs that there is some bearishness appearing, some bearish cracks, but the underlying trend is bullish until proven otherwise. And so therefore we could very reasonably have expected an early 20-week cycle trough to appear, because the underlying trend is still generally bullish. And so when this trough occurred, let me clear this chart, when this trough occurred over here in the first week of February, I immediately asked myself, could that possibly be an early trough of the 20-week cycle? I was expecting the 20-week cycle trough to occur in the middle of February. The beginning of February is 2 weeks early. 2 weeks early for a 20-week cycle is not very early at all. It's roughly 10%. It's a fairly small deviation. And so I did start wondering whether it was possible that that 20-week cycle trough could have occurred early. And I wrote a blog post about it, and I'm not going to repeat everything here in this video, but I would encourage you to go and read that blog post. Here is that blog post on the Hurst Cycles website. It is called "Is This a Mid-Channel Pause?" and I discussed the concept of a mid-channel pause, which I'm going to spend a moment just going through now with you, and discussed how it was therefore possible that the trough at the beginning of February was a trough of 20-week magnitude. Now, if we have a look at the price movement, the analysis that I'm showing you here is still possible. It's still valid, but I think it's becoming less and less likely, and I think it is becoming more and more likely that, in fact, the 20-week cycle trough did occur at the beginning of February. Let's just take a look at what we would expect if the 20-week cycle trough has not yet formed. If it has not yet formed, then we would expect price to drop down below the 20-day FLD, at which point we would enter into a short trade for the move down into the 20-week cycle trough. But look at the way in which price has been behaving. It crossed up above the 20-day FLD over here, dropped back down towards the FLD, didn't get anywhere near it, didn't touch it, and continued bouncing straight up again. Now that, to me, looks like a category A interaction. Possibly an early category B with a C, although the B-C category interaction is usually expected round about the 20-day cycle trough, and therefore the next interaction would be a category D interaction. But the important thing, before we start wondering about what interaction is coming next, the important thing to me is that that looks like an ABC configuration, and it doesn't look like, that's a bounce out of a 40-day cycle trough. So it doesn't look to me like, let me just clear this and show you what it doesn't look like to me. It doesn't look like this is an E category interaction. Because following an E category interaction, we would expect price to come down and we would go short for the F category interaction. So it doesn't have the right look to me. And so for that reason, I am very cautious of entering short at the level of the 20-day FLD. And that is because I believe that the 20-week cycle trough has formed, and formed at the beginning of February. Let's take a look at a chart where that 20-week cycle trough is actually phased in the analysis. Here you can see it. Now, in order for me to get Sentient Trader to actually do this analysis, as you can see, I had to pin various troughs. That I told Sentient Trader to place the trough there if it possibly could. And the reason I had to do that is because there are, I think, 48 days between those two troughs. Now, 48 days is really too short for a normal 80-day cycle. And so For that reason, I had to pin various troughs. But I think that this analysis is absolutely possible, and that this trough at the beginning of February was a 20-week cycle trough, and then we saw an A category interaction. So whereas many people were trading that interaction as an E category long interaction, it was in fact an A category long interaction, which again points out what I mean by Hurst cycles being a robust theory. We were taking the correct trade, even though, of course, it was an A category interaction instead of an E category interaction. Of course, some people were looking at that as a potential G category interaction, and so they didn't enter into that trade at all, which means, of course, they missed a profitable long trading opportunity, but at least they weren't entering into a losing trade. So that looks to me like an A category interaction. There have been, I think, 21 days. I can measure it in a moment. There have been 21 days since that 20-week cycle trough at the beginning of February, which means that I then expect price to come down to the FLD roundabout now to form a 20-day cycle trough. Now, it is possible that that is the 20-day cycle trough over there, but that really is a little bit early. Let's just measure some of these things. That little dip down there was at 7 days, which is almost certainly a 10-day cycle trough, not a 20-day cycle trough. And let me just display this count so that it stays on the chart. There we go. There have been 14 days, not 21. I've skipped a week somewhere. Okay, so there have been only 14 days since this 20-week cycle trough. So we've got a good-looking A category interaction over here. I would expect next a B category interaction coming down to the 20-day FLD. So that would be a B category interaction. Then, of course, we get a C category interaction as price bounces back up above the FLD. So the important thing in terms of trading for this week is we do expect price to come back to that 20-day FLD, as it does time and time again, and will continue to do for a very long time, for as long as we trade the markets. And so what should we do when price comes down to that 20-day FLD? Well, I think this looks like the most likely scenario at the moment, which means that we will expect price to come down to the 20-day FLD, track along the FLD, and then bounce back up again, which means I do not want to enter short when price comes down to the 20-day FLD. I will, in fact, be looking for an opportunity to go long again, because if that 20-week cycle trough has formed at the beginning of February, then the market still has more bullishness in it. So I will not be entering short at the level of the 20-day FLD. I will be looking for an opportunity to get into a long C category trade as price bounces back up above that FLD. If you disagree with me and think that the 20-week cycle trough does still lie ahead of us, then of course you probably would want to enter short at the level of that 20-day FLD, because you would be looking at this sort of scenario over here, and so you would be seeing this as an E category interaction, and you would be expecting an F category interaction next for price to come down to the 20-week cycle trough. That, as I've mentioned, is possible, it's viable, it's a valid analysis, but I do not think it is likely at the moment. You might have your own reasons for thinking that this is the correct analysis, in which case you will go short for an F category trade at the level of the 20-day FLD. I would caution against it. Let's just go back to that other chart and discuss how we might potentially get into a long C category trade. I use the 10-day FLD. I find it very useful for getting into a long C category trade, because I would expect price to come into what I call the bubble, which is the area between the 10-day and the 20-day FLD. So I would expect price to come into that bubble, which it will probably do this week, at which point I would set an entry for a long trade If I was feeling aggressive at the level of the 10-day FLD, if I'm feeling slightly less aggressive, I'll probably use the high of the price move, which was either Friday's high or potentially a high that forms later this week, and therefore get in at that level for another bit of a bounce up and a C category long trade. I'd just like to say one thing about the whole concept of a mid-channel pause. And let me draw a little bit of a diagram. I've had some people ask me, what is a mid-channel pause? What on earth do you mean? I'm going to try to explain it by means of a quick diagram here. Now, we are used to seeing M-shaped cycles. So let me draw an M-shaped cycle there. There we go, like that. That's the sort of simple version of the M-shaped cycle. When you add a little bit of extra detail to that M-shaped cycle, you will know that price comes up a little bit, and then it has a little bit of a wobble, and then it comes up to this peak, then it comes down, then it comes up to that peak, comes down, normally quite hard, has a little bit of a wobble again, and then down again. So that's still an M-shaped cycle, as I hope you can see, but with some added and extra detail. Now, our FLD trading strategy, of course, trades the interactions, which are A over here. B occurs at the sort of what I've called a wobble, and then C as it comes back up again, and then D as it drops down from the first peak, and then E as it bounces up again, and then F comes down again, and G and H are the wobble on the way down, and that completes our sequence. So what is this wobble on the way up and on the way down? Well, you know from the FLD trading strategy that if we're talking cycle strengths, then of course the cycle that I've drawn here starts with an 80-day cycle trough. That's 80-day. And down here in the middle we get a 40-day cycle trough, and the cycle ends, the sequence ends with another 80-day cycle trough, and of course these wobbles, as I've described them, occur at the position of the 20-day cycle. Now, Hurst called them, he didn't call them wobbles, he called them mid-channel pauses. And so basically the BC category interactions with the 20-day FLD, which occur round about the level or the time of the 20-day cycle trough, is what Hurst would have called a mid-channel pause. And mid-channel pauses are times where price, as you can see from the very rough diagram that I've drawn here, price does not come down hard into that cycle trough. It tends to form what I described as a wobble. That's really what it is. It sort of hangs around at that level. Now, I think you can see from this price action that that is exactly what we saw happening over here. So price came up strongly, and then it entered a kind of a level of consolidation, some people would call it. It entered a trading range, and it didn't come down very hard or very strongly into what I believe was the 20-week cycle trough. And that is very typical of a mid-channel pause. If that is a mid-channel pause, then it is the mid-channel pause of what cycle? Well, it's the mid-channel pause of the 18-month cycle. So, in other words, if that is a mid-channel pause, that tells us that the trough that formed in the middle of October is in fact an 18-month cycle. And the mid-channel pause occurs when the cycle 2 degrees shorter, or 2 levels lower in the nominal model, forms its own trough, and of course 2 cycles shorter than 18 months, as you can see here. That's 18 months. 1 down is 40 weeks, 2 down is 20 weeks. So the point at which the 20-week cycle forms a trough will often happen as the general cycle shape forms a mid-channel pause. So I think it's a very viable thing in terms of what's happening at in the markets at the moment. And I think it highlights the fact that that trough in the beginning of February was very possibly Perhaps even it is likely that that trough was a trough of the 20-week cycle. Of course, if it was a trough of the 20-week cycle, what must we do with our trading? I would be cautious of going short when price interacts with the 20-day FLD, and I am instead looking for a C category long trade as price bounces back up away from the 20-day FLD. Let's very quickly take a look at the euro, because I mentioned in one of the recent Hurst trading room videos that the euro was coming down into a very long cycle trough of probably at least 4.5 years magnitude, and that you have to be very careful as price comes down into that trough, because you must be careful of jumping in too soon just because a long cycle trough is expected to form. It doesn't mean that you should get trigger happy and jump in front of the moving train. The market should still be considered to be bearish until it proves itself otherwise. Now, as you can see, the market formed a trough here on the 26th of January, just after the Greek elections, as a matter of interest. It formed a trough, it hit a low point, and then it bounced back up again. I mentioned that I was going to wait until a full 40-day cycle had formed so that I could see that cycle shape before I would go long this market. And indeed, I'm going to do that. But let's have a look at what has happened and see whether we're getting any early indications of whether this very long magnitude cycle trough has formed yet. First of all, as you can see, I've left a VTL on this chart. The valid trend line, that's the 20-day valid trend line. Now, when price crossed up above that 20-day VTL, which it did on the 3rd of February, I think, that told us that the trough that the market was bouncing out of was of at least 40-day magnitude. So that's an important thing. And so you can see, according to this analysis, that trough on the 26th of January has been phased as only of 40-day magnitude, and we have no evidence that it was a trough of any greater magnitude. But of course, it is possible that that trough was the expected 4.5-year cycle trough. Here you can see the circle and whiskers for the 18-month cycle. It was in the 2nd or 3rd week of January. Here's the 40-week cycle trough, circle and whiskers. You can see the circle was right over that weekend. So that is exactly when that really long degree or magnitude cycle trough was expected. So it is possible. But before I am willing to trade on the basis of that, I want to see how this cycle shape develops. And let's just zoom in and see what the cycle shape has done so far. And I think you will see that it's not yet very impressive. But I must point out this often does happen at big magnitude troughs. Sometimes markets take a little bit of time to pick up speed. So this doesn't prove that this is not the big magnitude trough. I am nevertheless going to remain cautious. Here you can see price came up and crossed above the 20-day FLD. Now, if this was a very big magnitude cycle trough, then of course that would have been an A category interaction. If it was only a 40-day cycle trough, then it would have probably been an E category interaction. Then price came down to the FLD, and it has been sort of tracking along it in what is quite possibly a B category interaction, and next we will get a C category interaction. All right, so it's still looking okay. It's still making sense for this to have been a very big, strong cycle trough, very long cycle trough that formed at the end of January. That is still possible. The interaction between price and the FLD is not denying that. In fact, it does look more like an ABC category interaction so far than an EF category interaction, because of course if this was a trough of only 40-day magnitude as indicated at the foot of the chart, then this would have been an E category interaction, and we would then see an F category interaction happening next. Now, if category interactions don't usually consist of price tracking along the FLD, usually they cross nice and cleanly down below the FLD. Not all the time. It's a guideline. It's by no means a rule. But certainly this does look a bit more, to my mind, like an ABC than it does look like an E or F. But I'm not jumping into this trade yet. Let's have a look and see where the 10-day FLD. You can see the 10-day FLD is in an inverted position at the moment, so it would be difficult for us to get into a C category interaction. But I'm not going to necessarily jump into a long trade just yet. Let's have a look at the cycle shape so far. This is probably the 20-day cycle trough somewhere over here, and so far it's doing that. Is that a bullish cycle? Well, yes, so far it's fairly bullish as a 20-day cycle. That's a fairly bullish 20-day cycle. Not very bullish, I've got to say. And this whole week here, when the market went up and down and up and down, one day after another, is not really a particularly bullish sign. It indicates that the market's really struggling to find a direction. So this is not yet a bullish 40-day cycle by any means, and I am going to wait until the 40-day cycle completes before I actually trade this market with any confidence. The next 40-day cycle is expected, as you can see from the next circle and whiskers, is expected sometime over here. So that's in early March. If the market comes up strongly and reaches new highs and then comes down and manages to form a 40-day cycle trough at a higher level, then that would be a bullish 40-day cycle, and I would be interested in getting into the euro on the long side. If, on the other hand, this market doesn't manage to go any higher and instead drops down again over here, then we won't have a bullish 40-day cycle, and it looks as if though the long magnitude cycle trough still lies ahead of us. And of course the next possible candidate for that cycle trough to form will be the trough that I've already pointed out, which is expected sometime early in March. Thank you very much for joining me this week in the Hurst Trading Room. I look forward to seeing you next week and wish you, as always, profitable trading.